The information provided in this video is for educational and entertainment purposes only and does not constitute professional financial, legal, or insurance advice. Car insurance laws, regulations, and policy structures vary significantly by state and individual circumstances. While we strive for accuracy based on historical trends and industry data, insurance products are complex and subject to change. Viewers should conduct their own due diligence and consult with a licensed insurance agent or qualified legal professional before making any decisions regarding their coverage or claims. We do not guarantee specific savings or outcomes, as individual results depend on a multitude of factors including driving history, location, and credit score. Most Americans are overpaying for their car insurance by hundreds, if not thousands of dollars every single year, and the worst part is they have no idea it is happening. You might think you are protected because you have full coverage, but in the next 20 minutes, you are going to realize that full coverage is a term that does not actually exist in the legal world of insurance. Right now, there are millions of drivers hitting the road with a false sense of security, believing myths that were passed down from their parents or whispered in office break rooms. These myths are not just harmless misunderstandings. They are the primary reason why a single fender bender can lead to a multi-year financial struggle, or why your premiums might spike for reasons that seem completely unfair. We are pulling back the curtain on the multi-billion-dollar insurance industry to reveal the mechanics of how your rates are actually calculated and the 5 massive lies that are draining your bank account. If you have ever looked at your monthly premium and felt like you were being penalized for no reason, or if you are terrified of what happens if you actually have to file a claim, this deep dive is the masterclass you have been waiting for. By the end of this video, you will understand the hidden architecture of your policy better than most entry-level agents, and you will know exactly how to navigate the system to ensure you are never the victim of your own ignorance again. We are starting this journey by dismantling the foundation of how most people view their car insurance. For the average American household, car insurance is the 3rd or 4th largest recurring expense, yet it is the one we understand the least. We treat it like a commodity similar to gas or electricity, where we assume the price is the price. However, insurance is actually a personalized risk contract. Every time you sign that renewal, you are entering into a complex legal agreement where the stakes are your entire net worth. If you carry the wrong limits because you believed a common myth, a single judgment in a civil court could lead to wage garnishment for the next decade. This is about more than just a monthly bill. This is about asset protection and financial survival in an increasingly litigious society. Let's look at the first massive myth that governs how people shop for insurance: the idea that the color of your car affects your insurance rates. You have likely heard that red cars are more expensive to insure because they are associated with speed, aggression, and a higher likelihood of being pulled over by law enforcement. Statistically, people believe that if they buy a bright red sports car, the insurance company sees a red flag and automatically adjusts the premium upward. This is a foundational misunderstanding of how actuarial science works. Insurance companies do not care about the aesthetics of your vehicle. They care about the data points that correlate with the loss. When an insurance company evaluates a vehicle, they look at the vehicle identification number or VIN. This number tells them the year, make, model, engine size, and safety features. It does not communicate the paint code to the underwriting software in a way that impacts the base rate. To understand why this myth persists and why the reality is more complex, we have to look at how insurers actually categorize vehicles. They use something called a symbol or a rating group. These groups are determined by the cost of repairs, the frequency of theft for that specific model, and the historical performance of that car in accidents. For example, if you are driving a high-performance vehicle that happens to be red, your insurance is high because it is a high-performance vehicle, not because it is red. A silver version of that same high-performance car would cost the exact same amount to insure. Data from the Insurance Institute for Highway Safety shows that repair costs are driven by things like sensor calibration and bumpers, the type of headlights used, and the structural integrity of the frame. A red bumper and a white bumper cost the same amount of labor and material to replace. By focusing on the color, many Americans ignore the factors that actually drive up their costs, such as the lack of modern safety suites or a high theft rate ranking in their specific zip code. Moving deeper into the mechanics of your policy, we have to address the second and perhaps most dangerous myth: the concept of full coverage. If you call an agent today and ask for full coverage, they will likely give you a policy that includes liability, collision, and comprehensive. But here is the reality: full coverage is a marketing term, not a legal one. Believing in this myth leads to a massive gap in protection that many Americans do not discover until they are standing on the side of the road, with a totaled vehicle. Historical trends show that thousands of drivers every year are left with thousands of dollars in debt because they thought they were fully covered when they actually lack specific endorsements like gap insurance or new car replacement. Let's break down what a standard policy actually looks like versus what people think it covers. Liability insurance is the only part required by law in most states, and it is designed to pay for the other person's car and medical bills if you are at fault. It does nothing for you. Collision coverage pays for your car if you hit something, and comprehensive covers things like theft, fire, or weather damage. However, even if you have all three, you are not fully covered. For instance, if you have a loan on your car and the vehicle is totaled, the insurance company only owes you the actual cash value of the car at the time of the loss. If you owe $25,000 on a loan, but the car is only worth $20,000, you are responsible for that $5,000 difference. Without gap coverage, which is a specific addition, you are financially underwater. This is the gap between the myth and the reality of the contract. Furthermore, people often believe that full coverage means they have a rental car waiting for them if their car is in the shop. In reality, rental reimbursement is an optional add-on. Case studies of claims processes show that many drivers are shocked to find out they have to pay $30 or $40 a day out of pocket for a rental car, while their vehicle is being repaired, because they relied on the umbrella of full coverage, rather than reading the line items of their declarations page. This misunderstanding of the contract is what leads to the feeling of being cheated by the industry. The industry isn't necessarily hiding these things. They are written in the 60-page policy booklet that most people never open. As we progress through this masterclass, we are going to look at the third myth, which is the idea that your insurance will always cover you if your friend borrows your car. This is a nuanced area where the wrong assumption can lead to a denied claim and a personal lawsuit. Most people believe that insurance follows the driver, meaning if you have insurance, you are covered no matter what car you drive. While there is some truth to that in specific scenarios, in the United States, insurance primarily follows the vehicle. However, there are massive exceptions based on something called permissive use and excluded drivers. If you have a roommate or a family member living in your house who is not listed on your policy, and they get behind the wheel, your insurance company might deny the claim entirely based on an unlisted driver exclusion. Case studies in the insurance world show that companies are increasingly cracking down on household residents who are not disclosed. The logic is simple. The insurance company is taking on more risk than they agreed to for the premium you are paying. If you have a 20-year-old son living at home who has a history of speeding tickets, and you don't list him on the policy to save money, but then you let him drive your car to the store and he hits a pedestrian, you could be looking at a total loss of coverage. This is a high-stakes gamble that many Americans take every day without realizing the legal framework they are operating within. We are also going to dissect the fourth myth, the belief that your credit score has nothing to do with how you drive, and therefore shouldn't affect your insurance. In reality, in almost every state except for a few like California, Hawaii, and Massachusetts, your credit-based insurance score is one of the single most influential factors in determining your premium. This isn't about how well you pay your bills. It's about the statistical correlation between financial responsibility and driving behavior. Historical data used by actuaries suggest that individuals with higher credit scores tend to file fewer claims and are involved in fewer accidents. Whether this is a fair metric is a subject of intense debate, but as a consumer, you need to understand that improving your credit score could potentially lower your car insurance more than a clean driving record alone. Finally, we will tackle the fifth myth, which is the idea that if an accident isn't your fault, your rates won't go up. This is perhaps the most frustrating reality for drivers. You are sitting at a red light, someone rear-ends you, their insurance pays for everything, and yet, at your next renewal, your premium increases. While some states have laws preventing surcharges for not-at-fault accidents, many do not. Insurers look at the frequency of incidents. If you live in an area where people are constantly hitting you, the insurance company views you as being in a high-risk environment. They aren't necessarily punishing you for the accident. They are recalibrating the risk of insuring a vehicle in that specific geographical location, or based on your updated risk profile. This video is designed to give you the tools to stop being a passive consumer and start being a strategic policyholder. We are going to walk through the exact steps of how to audit your own policy, how to identify the hidden fees, and how to speak the language of insurance adjusters so that you are never caught off guard again. By the time we are done, the mystery of the insurance premium will be solved, and you will have a clear, data-driven understanding of how to protect your family and your finances on the American road. To truly understand the mechanics of these myths, we have to start with the most persistent one, the red car myth. Imagine a driver named Michael in Columbus, Ohio. It is early 2026, and Michael is shopping for a new vehicle. He has his eye on a bright red sports sedan. His neighbor tells him that if he buys that red car, his insurance premiums will skyrocket because red is the color of speed and aggression. This is one of the most widely held beliefs in the United States, yet it is fundamentally disconnected from how insurance companies actually calculate risk. When Michael calls his agent, the agent doesn't even ask what color the car is. Instead, they ask for the vehicle identification number. This 17-digit code is the only thing the insurance company's underwriting software cares about regarding the physical machine. It reveals the year, the make, the model, and the specific trim level. Historical trends in the insurance industry show that color has zero correlation with the base rate of a policy. Whether that sedan is cherry red, forest green, or appliance white, the cost of the metal, the glass, and the labor to repair it remains constant. The reason this myth exists is a classic case of confusing correlation with causation. Statistically, people who buy high-performance sports cars might choose bold colors like red. High-performance sports cars are more expensive to insure because they are capable of reaching higher speeds and often cost more to repair due to specialized parts. Therefore, if a red car has a high premium, it is because of the horsepower and the cost of the carbon fiber bumper, not the pigment in the paint. Let's look at a case study involving two identical 2024 SUVs. One is red and one is silver. In a controlled comparison of insurance quotes across the top 5 U.S. carriers in 2026, the premiums for both vehicles would be identical down to the cent, provided all other driver variables are the same. The data shows that insurers focus on loss ratios. They look at how many times that specific model of SUV has been involved in a claim over the last 3 years. If that model has a high frequency of occupant injuries, the premium goes up. If it has advanced autonomous braking systems that prevent rear-end collisions, the premium goes down. Color simply isn't a data point in the actuarial tables. By ignoring the color and focusing on the safety ratings provided by the Insurance Institute for Highway Safety, Michael can actually find a vehicle that lowers his overhead. Now let's pivot to a much more dangerous misunderstanding: the myth of full coverage. This term is a ghost in the machine of the insurance world. Imagine Sarah, a freelance graphic designer in Austin, Texas. Sarah believes she is fully covered because she opted for the highest tier of service her app offered. In her mind, this means if anything happens to her car, she is 100% protected. But in 2026, the reality of the US economy means that the actual cash value of vehicles is fluctuating wildly. Sarah gets into an accident that totals her car. She owes $22,000 on her auto loan, but because her car depreciated the moment she drove it off the lot, the insurance company determines its actual cash value is only $18,000. Sarah is shocked to find out that her full coverage leaves her with a $4,000 bill to the bank for a car she can no longer drive. This is because she lacked an endorsement called gap insurance. Historical trends indicate that as car prices rose throughout the early 2020s and into 2026, more Americans found themselves in this exact equity hole. Full coverage typically just refers to the combination of liability, collision, and comprehensive. It does not mean you are covered for the total financial loss of your investment. To go deeper, Sarah's policy also didn't include rental reimbursement. While her car is in the shop for 3 weeks due to supply chain delays in 2026, she is forced to pay $50 a day for a compact rental. Over 21 days, that is over $1,000 out of pocket. She thought she was fully covered, but the fine print of her contract proved otherwise. This is a step-by-step lesson in why you must look at your declarations page. You need to look for specific line items, gap coverage, rental reimbursement, and uninsured motorist property damage. Without these, the term full coverage is nothing more than a false sense of security that can lead to a massive financial setback. The third myth involves the idea that your insurance will cover you no matter who is driving your car. Let's look at a scenario involving David in Phoenix, Arizona. David's brother, who is visiting for the weekend, borrows David's truck to run to the grocery store. David assumes his insurance covers the truck, so it doesn't matter who is behind the wheel. However, David has a restrictive policy that uses a named driver exclusion. In many modern 2026 policies, especially those from non-standard or budget carriers, the coverage is only valid for people specifically listed on the policy. If the brother gets into an accident, the insurance company could deny the claim entirely, leaving David personally liable for tens of thousands of dollars in damages. Case studies show that insurance companies are becoming increasingly granular with their risk assessments. In the past, permissive use was a standard feature of almost every policy. This meant that as long as you gave someone permission to drive your car, they were covered. But to keep premiums competitive in a high-inflation environment, many companies have moved toward more restrictive language. They might cover a guest driver, but only at the state minimum limits, which in some states are as low as $15,000. If your friend causes $50,000 in damage while driving your car, and your policy drops to the state minimum for guest drivers, you are on the hook for the remaining $35,000. This is a potential outcome that most Americans never consider until the legal summons arrives in the mail. Furthermore, we have to address the myth of the credit score. Many people believe that because they have a perfect driving record, their insurance should be low. Imagine Jennifer in Florida. She hasn't had a ticket or an accident in 15 years. However, her insurance premium just took a 20% jump. She hasn't changed anything, but her credit score dropped because of some high medical bills. In the eyes of the insurance industry in 2026, Jennifer is now a higher risk. Data from major credit bureaus and insurance aggregators shows a direct statistical link between financial stability and claim frequency. It isn't about Jennifer's ability to steer a car. It is about the statistical likelihood that someone under financial stress might file a claim for a small dent rather than paying for it out of pocket. In nearly every state, your credit-based insurance score is a more significant driver of your rate than your actual driving history. Understanding this allows you to stop blaming the DMV and start looking at your financial profile as a tool for lowering your insurance costs. But what happens when the accident isn't even your fault? There is a widespread belief that if someone hits you, your insurance company won't care. You might think that because the other person's insurance is paying, your record remains clean. This brings us to the most frustrating myth of all: the idea that not-at-fault accidents don't impact your premium. In reality, the mere fact that you were involved in an incident creates a data point. If you are involved in 3 not-at-fault accidents in 2 years, the insurance company sees a pattern of you being in the wrong place at the wrong time. In their predictive models, this makes you a higher risk for a future accident that might be your fault. As we move forward, we are going to dive into the specific math of how these companies track you through shared databases like the CLUE report. You might think your secrets are safe, but the insurance industry has a collective memory that spans decades. If you think these 5 myths were eye-opening, wait until you see how your digital footprint and even the neighborhood you live in are being used to build a profile of you that determines how much of your paycheck is diverted to these premiums every month. In the next part, we are going to break down the hidden reports that every insurance company pulls before they even give you a quote, and how one tiny mistake on a document from 5 years ago could be costing you thousands of dollars today. To understand why your premiums are what they are in 2026, you have to understand the CLUE report. This stands for Comprehensive Loss Underwriting Exchange. It is a massive database maintained by LexisNexis that contains up to 7 years of your personal claims history. Every time you call your insurance company just to ask if something might be covered, even if you never actually file a formal claim, there is a potential outcome where that inquiry is logged as a $0 claim. This is the hidden trap that catches millions of American drivers. Imagine a homeowner and driver named Marcus in Atlanta, Georgia. Marcus sees a small crack in his windshield and calls his agent to ask if his glass coverage has a deductible. He decides the crack is too small to worry about and hangs up. 3 years later, Marcus tries to switch insurance companies to save money, only to find that his quotes are significantly higher than expected. Why? Because that simple phone call was recorded in the CLUE report as an inquiry. To a new insurance company, several inquiries look like a driver who is constantly on the verge of filing a claim, which shifts their risk profile from low to moderate. This database is the nerve center of the industry. It includes the date of the loss, the type of loss, and the amount the insurance company paid out. If you had a fender bender in a parking lot back in 2021, it is still sitting there in 2026, influencing the math of your monthly bill. Many Americans believe that if they change companies, they are starting with a clean slate. This is a myth. The first thing a new carrier does is run your name, birth date, and social security number through LexisNexis. They see every glass chip, every tow truck you called for through your roadside assistance, and every minor scrape. Step by step, these data points are fed into an algorithm that determines your tier. If you have 3 roadside assistance calls in a 12-month period, you might be moved from a preferred tier to a standard tier, which can result in a 20 to 30% increase in premium, even if you have never had a moving violation. Now, let us look at the geographic myth. Most people believe that their insurance rate is based solely on their own driving habits. While your behavior matters, your physical location is often the primary driver of the base rate. Consider a scenario with a driver named Elena in Chicago. Elena lives in a quiet neighborhood and has a garage. She moves just 3 miles away into a different zip code that is closer to a high-traffic commercial district. Her insurance premium jumps by $400 a year. Elena has not changed her car, her job, or her driving habits, but the insurance company's data shows that the new zip code has a higher historical trend of vehicle thefts and catalytic converter replacements. In 2026, with the rise of integrated sensor technology in cars, even a minor theft of a side mirror can cost $3,000 to repair. The insurance company is not rating Elena. They are rating the probability of a crime or accident happening within the boundaries of that specific zip code. Case studies in high-density urban areas like Los Angeles or Miami show that insurance companies use heat maps to determine pricing. If your car is parked in a zone where flash flooding is common during the summer, your comprehensive coverage will be priced higher than someone living on a hill 5 miles away. This is the granular level of data that Americans often overlook. You are being grouped with your neighbors. If your neighbors are prone to filing claims for hail damage, or if there is a high rate of uninsured motorists in your immediate vicinity, you are subsidizing that collective risk through your premium. This is why shopping for insurance based on price alone, without understanding the rating factors of your area, is a losing game. Beyond your zip code, there is the myth of the professional discount. You might have heard that doctors, lawyers, or engineers get lower rates because they are seen as more responsible. While some companies do offer affinity discounts, the data in 2026 shows a shift toward usage-based insurance or telematics. Imagine a young professional named Tyler in Seattle. Tyler is a civil engineer, a profession traditionally associated with lower risk. However, Tyler has a 40-minute commute on a highway notorious for accidents. Tyler's insurance company offers him a discount if he plugs a tracking device into his car or uses an app to monitor his driving. Tyler assumes his professional status will carry him, but the telematics data shows he consistently hard brakes at a specific intersection every morning. In this case, Tyler's professional discount is completely offset by his driving data. Telematics is the future of the industry, but it is also a double-edged sword. Historical trends show that while these programs can lower rates for very low-mileage drivers, they can actually lead to rate increases for people who have to drive during high-risk hours, such as midnight to 4 a.m. If your job requires you to work a late shift at a hospital or a warehouse, the insurance company views your time on the road as statistically more dangerous due to the presence of tired or impaired drivers. Even if you are a perfect driver, being on the road at 2 a.m. in 2026 puts you in a different risk category than someone who only drives at 10 a.m. on a Tuesday. This brings us to the hidden mechanics of the premium hike. Have you ever noticed your rate goes up even when you have done nothing wrong? This is often due to something called price optimization. This is a controversial practice where insurance companies use data analytics to predict how likely a customer is to shop around if their rate increases. If the data shows that a customer like Elena in Chicago has been with the same company for 15 years and rarely compares prices, the company might implement a small, incremental increase every year. They are not charging Elena more because her risk has increased. They are charging her more because they believe she is unlikely to leave. This is why loyalty in the insurance industry often carries a hidden tax. Case studies have shown that long-term customers sometimes pay significantly more than new customers with the exact same risk profile. To combat this, you have to understand the step-by-step process of an insurance audit. You should be looking at your policy every 6 months and asking for a re-rate. A re-rate allows the company to look at your current credit score, your current driving record, and any new safety features your car might have that were not previously accounted for. In 2026, many cars have over-the-air software updates that can add safety features like enhanced pedestrian detection. If you do not inform your insurer that your vehicle has been upgraded, you are leaving money on the table. We also need to address the myth of the one-size-fits-all deductible. Most Americans choose a $500 deductible because it feels like a safe middle ground number. However, if you look at the math over a 5-year period, this is often a mistake. Imagine Marcus in Atlanta again. By moving his deductible from $500 to $1,000, he saves $300 a year on his premium. In less than 2 years, Marcus has saved enough in premiums to cover the extra $500 he would owe in the event of an accident. Statistically, the average American driver files a collision claim once every 10 years. By carrying a lower deductible for a decade, You are potentially paying thousands of dollars in extra premiums for a benefit you rarely use. This is the difference between emotional financial planning and mathematical financial planning. As we peel back more layers of this industry, we have to look at how your digital life is starting to intersect with your driving profile. In the next part, we are going to explore the emergence of social media monitoring and how the things you post online could be used by adjusters to deny your claims. We are also going to look at the reality of the black box in your car. Most people think it only records speed during a crash, but in 2026, these devices are capturing much more than that. We are going into the laboratory of the insurance adjusters to see exactly what they see when they look at your file, and the one question you should never answer during a recorded statement after an accident. This one mistake is the primary reason claims get denied in the United States every single day. Let us talk about that recorded statement, because this is where the legal architecture of your car insurance policy meets the cold reality of a claims investigation. Imagine a driver named Chloe in Nashville, Tennessee. It is 2026, and Chloe was just involved in a moderate intersection collision. She is shaken up, but she feels fine physically. An hour after the accident, an insurance adjuster from the other driver's company calls her. They sound incredibly empathetic. They tell Chloe they just want to get her side of the story, so they can settle the claim quickly. Then they ask the one question that functions as a trap. How are you feeling today? Chloe, trying to be polite and genuinely believing she is okay, says, I am fine, thank you. To the average person, this is a social nicety. To a trained insurance adjuster, this is a recorded admission that there are no bodily injuries. 2 days later, when the adrenaline wears off and Chloe realizes she has a significant whiplash injury or a herniated disc that requires thousands of dollars in physical therapy, that recorded statement is used as evidence to deny or severely devalue her medical claim. Historical trends show that insurance companies prioritize these early statements because they occur before a claimant has had time to consult with a professional or fully understand the extent of their injuries. The myth here is that the insurance adjuster is there to help you. In reality, their primary fiduciary responsibility is to their shareholders, which means minimizing the payout on every claim. Step by step, they lead you through a series of questions designed to establish contributory negligence. They might ask, what time were you supposed to be at work? If Chloe says she was due at 9 a.m. and the accident happened at 8:55 a.m., they now have a data point suggesting she may have been rushing or speeding, even if she was not. This is why the standard advice in 2026 remains: do not give a recorded statement to the other driver's insurance company without understanding your legal rights. You are generally required to cooperate with your own insurance company, but even then, you should be precise and stick strictly to the facts of the impact, not your personal feelings or interpretations of the event. Beyond the phone call, we have to address the myth of the black box, officially known as the Event Data Recorder or EDR. Many Americans believe these devices only exist in airplanes. The reality is that almost every vehicle manufactured after 2013 in the United States is equipped with one. In 2026, these devices have become incredibly sophisticated. Imagine a driver named Robert in Denver. Robert is involved in a high-speed collision and claims he was going the speed limit. However, the insurance company pulls the data from his EDR. This device does not just record speed. It records the throttle position, the brake application, the steering angle, and even whether the occupants were wearing seatbelts in the 5 seconds leading up to the impact. Case studies in 2026 show that EDR data is increasingly being used in civil court to disprove driver testimony. If Robert's data shows he did not apply the brakes until 0.5 seconds before impact, but he claimed he was braking for a long time, his credibility is destroyed. The insurance company uses this to shift the percentage of fault. In states with comparative negligence laws, if they can prove you were even 10% at fault because you were distracted or slightly over the speed limit, they can reduce your settlement by that same 10%. This is not science fiction. This is the current standard for high-stakes insurance investigations in the U.S. Now let us move into the digital frontier. The myth that your private social media has no impact on your insurance. Imagine Sarah in Miami. She filed a claim for a back injury after a car accident, stating she can no longer lift heavy objects or work her job at a warehouse. A week later, she posts a video on a popular social media platform of herself dancing at a friend's wedding or lifting her toddler. In 2026, insurance companies use specialized AI software to scrape public and even semi-private digital footprints. They are looking for inconsistencies. If Sarah's digital life contradicts her medical claim, her claim will not only be denied, but she could face an investigation for insurance fraud. Historical trends indicate that fraud investigations have surged as digital monitoring tools have become more accessible. It is not just about the accident itself, it is about the lifestyle you project. Even your LinkedIn profile can be used. If you claim you are unable to work due to an accident, but your LinkedIn shows you starting a new, physically demanding role, the insurance company will find it. They are looking for any data point that suggests the loss is less severe than reported. This level of surveillance is a shock to most Americans, but it is a standard part of the claims handling manual for major carriers. This leads us to the fourth myth in this section: the belief that the insurance company must pay for original equipment manufacturer or OEM parts. Imagine Marcus in Atlanta again. His car is 2 years old and he gets into a fender bender. He takes it to a high-end body shop and demands that they use genuine parts from the manufacturer. He is shocked when the insurance company refuses to pay the full price, offering only the cost of aftermarket or recycled parts. Most people believe their insurance is meant to put the car back to the way it was. While that is true in a broad sense, the fine print of almost every standard U.S. policy allows the insurer to use parts of like kind and quality. Aftermarket parts are made by third-party companies, not the original manufacturer. They are significantly cheaper, which helps the insurance company keep claim costs down. In 2026, the debate over aftermarket parts has intensified because of the complex sensors located in bumpers and mirrors. If an aftermarket bumper is not perfectly calibrated, the car's advanced safety systems might fail. Yet, unless you have a specific OEM endorsement on your policy, which usually costs an extra 5 to 10% in premium, you have very little legal standing to demand original parts. This is a step-by-step realization that the policy you bought is often a budget-optimized contract, rather than a premium protection plan. Finally, we must dismantle the myth of the disappearing deductible. Some companies advertise that for every year you drive safely, your deductible drops by $100. While this sounds like a great deal, you have to look at the math. Case studies of these programs often reveal that the premium you pay for this feature is higher than the actual benefit you receive. For example, you might pay an extra $60 a year for the vanishing deductible feature. If it takes 5 years to get your $500 deductible down to zero, you have paid $300 in extra premiums for a benefit you only use if you actually have an accident. If you go 10 years without an accident, you have paid $600 to avoid a $500 deductible. This is the insurance version of a high-interest loan. As we move toward the next part of this masterclass, we are going to dive into the world of liability limits. Most Americans are driving around with limits that were set in the 1970s, completely unaware that a single accident in 2026 could result in $1 million judgment. We are going to look at the terrifying reality of what happens when your insurance runs out but the bills keep coming. We will also explore the hidden world of medical payments versus personal injury protection, and why choosing the wrong one could leave you bankrupt, even if you have health insurance. If you think you understand your coverage because you have a gold or platinum plan, the next section is going to be a massive wake-up call regarding the actual limits of your protection. This brings us to the terrifying reality of liability limits, and the myth that state minimums are enough to protect you. Imagine a driver named Kevin in Charlotte, North Carolina. It is 2026, and Kevin is a hardworking professional who takes pride in his responsible driving. To save money on his monthly expenses, he opted for the state minimum liability limits. In North Carolina, like many other states, those limits might be as low as $30,000 for bodily injury per person and $25,000 for property damage. Kevin thinks he is fine because he is a safe driver and insurance is just a legal formality. One rainy Tuesday morning, Kevin is momentarily distracted by a notification on his dashboard. He hydroplanes and slides into a late-model electric luxury SUV. The impact is significant. The other driver, a surgeon named Dr. Miller, suffers a complex wrist injury that requires surgery and months of rehabilitation. Furthermore, the luxury SUV is a total loss. In 2026, a high-end electric SUV can easily cost over $100,000 due to the specialized battery technology and advanced sensor arrays. Kevin's insurance company steps in, but they quickly realize the gravity of the situation. They pay out the maximum of $25,000 for the car and $30,000 for Dr. Miller's injuries. But here is the math that keeps people awake at night. The car was worth $105,000, and Dr. Miller's medical bills plus lost wages for missing surgeries total $200,000. Kevin is now personally responsible for the remaining $80,000 for the vehicle, and $170,000 for the medical and wage claims. That is $250,000 in personal liability. In the United States, if you do not have the insurance coverage to pay for the damage you cause, the other party can sue you personally. They can go after your savings, your home equity, and even garnish your future wages for years to come. Historical trends show that as vehicle prices and medical costs have surged in the mid-2020s, state minimums have become a recipe for financial ruin. Many Americans believe that by choosing the lowest legal limit, they are being smart with their money, but they are actually taking a massive gamble with their entire net worth. Let us look at a case study from 2026 involving umbrella policies. An umbrella policy is an extra layer of liability protection that sits on top of your auto and home insurance. Many people believe these are only for the ultra-wealthy. However, the data suggests that for a few $100s a year, an average middle-class family can secure an extra $1 million in protection. Imagine if Kevin had spent an extra $20 a month on higher liability limits and an umbrella policy. Instead of facing bankruptcy and wage garnishment, his insurance company would have handled the entire $300,000 claim. This is a step-by-step lesson in the difference between the cost of a premium and the cost of a catastrophe. This leads directly into the myth of medical coverage. In the US, you will often see options for medical payments known as MedPay or personal injury protection known as PIP. Many people skip these because they already have health insurance through their employer. Imagine a driver named Maria in Orlando, Florida. Maria has an excellent health insurance plan. She gets into an accident and is rushed to the emergency room. She assumes her health insurance will take care of everything. However, she discovers that her health insurance has a $6,000 deductible and high copays for out-of-network specialists. If Maria had opted for PIP or MedPay on her car insurance, that coverage would have kicked in immediately to cover her deductible and copays, often regardless of who was at fault. In states like Florida, PIP is mandatory, but the limits are often surprisingly low, usually $10,000. In 2026, a single night in a major trauma center can exceed $20,000 before the first surgery even begins. Case studies show that drivers who rely solely on health insurance often find themselves buried in medical debt after a collision because they didn't realize that car insurance medical coverage is designed to be the first line of defense. PIP even covers things that health insurance does not, such as lost wages or essential services like house cleaning if you are too injured to perform those tasks. Another massive myth is the belief that your insurance company will always fight for you in court. Many Americans imagine that if they are sued after an accident, their insurance company will provide a high-powered legal team that will protect them at all costs. While your insurance company does have a duty to defend you, that duty usually ends the moment they pay out your policy limits. If Kevin's insurance company hands over the $30,000 to Dr. Miller, they may have fulfilled their contractual obligation. They might not be required to provide a lawyer for the remaining $270,000 lawsuit. This is a nuance in the fine print that can leave a driver standing alone in a courtroom against a team of seasoned personal injury attorneys. We also have to talk about the myth of the safe driver discount. In 2026, companies use big data to redefine what a safe driver actually is. You might have a clean record for 20 years, but if you live in a city where the number of distracted driving accidents has increased by 40%, your safe driver discount might be entirely consumed by a base rate increase for your entire demographic. Historical trends indicate that insurance companies are moving away from rewarding past behavior and toward predicting future risk based on real-time environmental data. If you are not actively shopping your rate every year, you are essentially paying a loyalty penalty. Let us dive into the mechanics of uninsured and underinsured motorist coverage. There is a myth that as long as you have good insurance, you don't need to worry about other people. But consider this. In some parts of the United States, nearly 1 in 5 drivers is on the road with no insurance at all. If one of those drivers hits you and causes a permanent injury, your own liability insurance does nothing for you. Your collision coverage will fix your car, but it won't pay for your ongoing medical care or your inability to work. Uninsured motorist coverage is arguably the most important part of your policy because it is the only part that protects you from the negligence of others. In 2026, with the rising cost of living, the number of uninsured drivers is at a historical peak. Case studies show that victims of hit-and-run accidents who lack this specific coverage often end up with no recourse whatsoever. They are left with the physical pain and the financial burden, while the person who hit them disappears into the night. Understanding the step-by-step breakdown of your declarations page is the only way to ensure you aren't one of these statistics. As we move into the next part of this masterclass, we are going to expose the secrets of the insurance repair industry. We will look at why the shop the insurance company recommends might not be the best place for your car, and how the term direct repair program is often just a way for insurers to control costs at the expense of your vehicle's safety. We are also going to reveal the hidden reason why your car might be totaled even if the damage looks minor. If you have ever wondered why a small dent in a modern car can lead to a total loss payout, you are about to see the shocking reality of 2026 vehicle engineering and the hidden sensors that make repairs nearly impossible for the average shop. The myth that a car must look like a crushed soda can be considered a total loss is one of the most expensive misunderstandings a driver can have in 2026. Imagine a driver named Brian in Seattle. Brian is driving his late-model electric sedan when he is involved in a relatively low-speed collision. To the naked eye, the damage looks minor: a cracked bumper, a shattered headlight, and a slightly dented fender. Brian assumes it is a $5,000 repair job. However, when the insurance adjuster arrives, they declare the vehicle a total loss. Brian is baffled. How can a car that still drives perfectly be headed for the scrapyard? The reality lies in the hidden architecture of modern vehicle engineering. In 2026, cars are no longer just mechanical machines. They are sophisticated computers on wheels. That bumper Brian cracked contains a suite of ultrasonic sensors, radar units for adaptive cruise control, and cameras for 360-degree parking assistance. A single headlight assembly on a modern vehicle can cost upward of $4,000 because of laser light technology and integrated cooling systems. But the real reason for the total loss is often the frame and the calibration requirements. Case studies from 2026 insurance data show that the cost of recalibrating advanced driver assistance systems, or ADAS, has become a primary driver of total loss declarations. If a frame is off by even a fraction of a millimeter, the long-range radar might be aiming 3 feet to the left of where it should be. The labor hours required to put a car on a specialized frame machine and then perform a static and dynamic recalibration of every sensor often exceed the vehicle's remaining value. Furthermore, in electric vehicles, any impact near the battery casing usually results in an automatic total loss due to the high risk of thermal runaway and the sheer cost of replacing a 10,000-pound lithium-ion pack. Brian's minor fender bender became a $30,000 liability the moment those sensors were compromised. This leads us to another massive myth: the idea that the insurance company's recommended repair shop is the best place for your vehicle. This is known in the industry as a direct repair program, or DRP. Imagine a driver named Lisa in Denver. After an accident, her insurance company tells her they have a network of preferred shops that will provide a lifetime warranty on the work. Lisa feels relieved, thinking the insurance company is looking out for her. What she doesn't realize is the nature of the contract between the insurance company and that shop. Historical trends in the automotive repair industry reveal that DRP shops often agree to discounted labor rates and the use of alternative parts in exchange for a steady stream of referrals from the insurance carrier. This creates a potential outcome where the shop's primary loyalty is to the insurer, not the car owner. These shops are often under intense pressure to minimize repair times and costs. If the insurance company wants to use a recycled or aftermarket suspension component to save money, a DRP shop is much less likely to push back than an independent, high-end certified collision center. Step by step, the quality of your repair can be eroded by these cost-saving measures. For instance, a DRP shop might skip the necessary pre-repair and post-repair diagnostic scans that reveal hidden electronic faults. In 2026, if those scans aren't performed, your car might look beautiful on the outside, but its safety systems could be offline. You have the legal right in almost every state to choose your own repair facility. While the insurance company might warn you that they won't guarantee the work of an outside shop, a reputable manufacturer-certified shop will provide its own warranty that is often superior to the one offered by the insurer. Let us look at a scenario involving Jennifer in Chicago, who decided to take her car to a manufacturer-certified facility instead of the insurance company's preferred shop. The certified shop identifies that the safety sensors in the seatbelts were triggered during the impact, something the insurance adjuster missed. Because this shop isn't beholden to the insurance company's bottom line, they insist on replacing the entire safety system with original equipment manufacturer parts. This ensures Jennifer's car is actually safe to drive, rather than just looking safe. This is the difference between a repair designed to save a corporation money and a repair designed to protect a human life. We must also dismantle the myth of the deductible waiver. Many Americans believe that if an accident is not their fault, they don't have to pay their deductible. Imagine Marcus in Atlanta again. Someone hits his car and speeds off. A classic hit and run. Marcus has the other person's license plate number and a witness. He calls his insurance and is shocked when they tell him he still has to pay his $500 deductible to get the repair started. This is because your contract with your insurance company states that for any collision claim, you are responsible for the first portion of the cost. The only way you get that money back is through a process called subrogation. This is where your insurance company goes after the at-fault party or their insurance company to recover the costs they paid out, including your deductible. This process can take months or even years. In the meantime, you are out that $500. Even in clear-cut cases where the other driver stays at the scene and admits fault, your insurance company may still require you to pay the deductible up front if you want them to handle the repairs quickly. Believing that a not-at-fault status is a get-out-of-paying-the-deductible card is a misunderstanding that leaves many families in a cash flow crunch following an accident. Furthermore, let us talk about the myth of the clean title. Many people believe that once a car is repaired, its value returns to what it was before the accident. This ignores the concept of diminished value. Even if a car is repaired perfectly by the best shop in the country, it now has an accident history on reports like Carfax or AutoCheck. In 2026, buyers are more savvy than ever. A car with a significant accident history will almost always sell for less than an identical car with no history. Historical trends show that a high-end vehicle can lose 15 to 20% of its resale value simply by having a major claim on its record. In some states, you can file a diminished value claim against the at-fault driver's insurance to recover this lost equity. However, most people have no idea this exists. Insurance companies certainly won't volunteer this information. They will pay for the metal and the paint, but they won't cut you a check for the invisible loss in your car's market value unless you demand it and provide a professional appraisal to back it up. This is another layer of the financial loss that most Americans simply absorb without a fight. As we move deeper into this masterclass, we are going to look at the massive world of non-standard insurance and why the companies you see advertising during late-night television might be a trap for your bank account. We will also explore the reality of the 24-hour claim service and why a quick payout isn't always a good thing. We are going to reveal the specific tactics used by adjusters to get you to sign away your rights to future medical claims for a few $100s in cash. If you think the hard part of an accident is the crash itself, you are about to see that the real battle begins when the first check is offered. In the next part, we are breaking down the art of the settlement and how to know if you are being lowballed by the very company you have paid for years to protect you. The art of the settlement is where the insurance industry's mathematical efficiency meets your personal financial reality, and the myth that a quick check is a fair check is perhaps the most expensive lie of all. Imagine a driver named Anthony in Philadelphia. It is 2026, and Anthony has just been rear-ended. The other driver's insurance company calls him within 48 hours. They are incredibly friendly and offer him a settlement of $2,000 for his trouble, plus the cost of his car repairs. To Anthony, who is staring at a stack of bills and a cracked bumper, this feels like a win. He signs the release, takes the electronic transfer, and thinks the ordeal is over. What Anthony has actually done is sign away his right to ever ask for another penny. 2 weeks later, the dull ache in his neck turns into a debilitating radiating pain. A scan reveals a herniated disc that will require a $25,000 microdiscectomy. Because Anthony accepted that initial lowball settlement and signed a general release of all claims, he is now personally responsible for every cent of that medical bill. Historical trends in the U.S. insurance market show that companies use a tactic called swoop and settle. They identify claims with high potential for long-term medical costs and attempt to settle them before the true extent of the injury is known. This is not a conspiracy. It is a standard business practice designed to limit the company's future liability. To understand how to avoid this, we need to look at the step-by-step mechanics of a personal injury claim. In 2026, the cost of medical care has outpaced general inflation, making the stakes higher than ever. When an adjuster offers you a settlement, they are calculating the nuisance value of the claim. They are betting that you need the cash now more than you need the long-term security of a full medical recovery. Case studies show that individuals who wait until they have reached maximum medical improvement before settling often receive significantly higher compensation because they have documented, undeniable evidence of their losses. You are not being greedy by waiting. You are being precise. You are ensuring that the contract you paid for actually fulfills its purpose of making you whole. This leads us to the myth of the total loss valuation. Imagine a driver named Samantha in Portland, Oregon. Her car has been totaled, and the insurance company sends her a valuation report stating her vehicle is worth $18,000. Samantha knows she couldn't buy an equivalent car for less than $22,000 in the current 2026 market. The myth is that the insurance company's valuation is the final word. In reality, these valuations are often generated by third-party software like CCC Intelligent Solutions or Mitchell International. These programs pull comparable sales data from various sources, but they frequently use cars that are not truly comparable. Perhaps they have higher mileage, fewer features, or are located in a different market area. Samantha has the right to challenge this valuation. The step-by-step process involves finding your own comparables. She should look for the exact year, make, model, and trim level with similar mileage within a 50-mile radius. In 2026, with used car prices remaining volatile, providing 5 local listings from reputable dealers can force an adjuster to recalibrate their offer. Furthermore, Samantha can invoke the appraisal clause in her policy. This is a little-known provision that allows for an independent appraisal process if the two parties cannot agree on the value. Many Americans simply accept the first number they are given, leaving thousands of dollars on the table because they believe the insurance company has a monopoly on the truth. Now, let's talk about the myth of non-standard insurance companies. You see their commercials everywhere, often featuring bright colors, catchy jingles, and a focus on getting you legal for the lowest possible price. These companies cater to high-risk drivers, or those looking for the absolute minimum monthly outflow. Imagine a driver named Jordan in Houston. Jordan chooses a non-standard carrier because it saves him $40 a month. In 2026, when Jordan gets into an accident, he discovers the hidden cost of that $40 saving. Non-standard carriers often have much more restrictive policy language. They might have lower caps on labor rates for repairs, stricter requirements for reporting accidents, and a much more aggressive approach to denying claims based on technicalities. Historical trends show that these companies often have higher complaint ratios with state insurance departments. Their business model is built on high volume and low payouts. If Jordan's car is in the shop, he might find that his policy only pays $20 a day for a rental, while the cheapest rental in Houston in 2026 is $45. He is paying the difference out of pocket. Worse, if he is sued, these companies may provide a less robust defense compared to a major top-tier carrier. The myth that all insurance is the same as long as it meets the state requirement is a dangerous fallacy. You get what you pay for in terms of the claims experience and the legal protection provided when things go wrong. Let's dive into a specific case study involving the cooperation clause. Every insurance policy in the U.S. has one. It requires you to cooperate with the company's investigation. Imagine a driver named Taylor in Phoenix. Taylor is involved in a minor scrape, but is busy with work and ignores several calls from his own insurance adjuster. Because Taylor failed to cooperate, the insurance company can legally deny the claim and refuse to defend him if the other driver sues. In 2026, insurers are using this clause more frequently as a way to close files quickly. They will send a letter stating that due to a lack of cooperation, coverage is being withdrawn. This leaves Taylor completely exposed. The lesson here is that while you should be careful about what you say, you cannot simply ignore your insurer. We also have to address the myth of the 24-hour claims service. We live in an age of instant gratification, and insurance companies capitalize on this by advertising how fast they can pay out a claim through their app. While speed is great for a simple glass claim, it can be a trap for anything involving structural damage or injury. In 2026, AI-driven photo estimation is becoming the standard. You take 4 pictures of your car, and an algorithm tells you the repair cost is $1,200. You click accept and the money is in your account in minutes. The problem? An algorithm cannot see hidden frame damage, it cannot feel if a suspension component is bent, and it cannot see the internal failure of a safety sensor. By accepting that instant AI payout, you may be agreeing to a settlement that is based on a superficial analysis. Case studies have shown that supplemental claims, where the shop finds more damage after they start working, are much harder to get approved once you have already accepted an initial payout and started the work. The industry wants you to use the app because it reduces the need for expensive human adjusters and often results in lower overall payouts. Furthermore, let's look at the myth of the medical authorization form. After an accident, the insurance company will ask you to sign a document allowing them to access your medical records. Most people think this is a standard and necessary step. However, these forms are often drafted so broadly that they allow the insurance company to dig through your entire medical history, going back decades. If you have a back injury in 2026, they will use that form to find out if you ever saw a chiropractor in 2012. If they find anything, they will argue that your current pain is a pre-existing condition, not a result of the accident. You have the right to limit the scope of these authorizations to only the records relevant to the current injury, but you have to be proactive to protect your privacy and your claim. As we move into the final stretches of this masterclass, we are going to look at the hidden world of insurance scores and how your digital shopping habits are being used to predict your driving risk. We are also going to reveal the specific documents you need to keep in your car and the ones you should never keep there. We will explore the reality of rideshare insurance and why millions of Uber and Lyft drivers are essentially driving without any coverage at all for a significant portion of their day. If you think you are protected because you have a commercial app open, the next part is going to show you the massive insurance gap that is ruining lives in 2026. The rideshare insurance gap is one of the most misunderstood and financially devastating pitfalls in the modern American economy. Imagine a driver named Carlos in San Diego. It is 2026, and Carlos has been driving for a major ride-sharing platform for 3 years to supplement his income. Carlos has a personal auto insurance policy that he pays for every month, and he knows the rideshare company provides insurance while he is working. He feels completely protected. One afternoon, while Carlos has his app on and is driving toward a high-demand area, but has not yet accepted a specific ride request, he is involved in a serious accident. Carlos assumes either his personal insurance or the rideshare company's insurance will step in. Instead, he enters a legal no-man's land known as Period 1. Historical trends in 2026 show that personal insurance policies almost universally exclude coverage for any business use of the vehicle. The moment Carlos turned on that app with the intent to make money, his personal policy became effectively void for that trip. On the other side, the rideshare company's high-limit liability coverage often only kicks in fully during Period 2, when a ride is accepted, and Period 3, when the passenger is in the car. During Period 1, the rideshare company may only provide very low contingent liability limits, and they almost never provide collision coverage for Carlos's own vehicle. In this scenario, Carlos is left with the totaled car and potential lawsuits from the other driver, and neither insurance company is obligated to help him. Case studies from across the United States in 2026 highlight thousands of drivers who have lost their primary source of income and face personal bankruptcy because they didn't realize they needed a specific rideshare endorsement on their personal policy. This endorsement is the bridge that closes the gap between personal and commercial use. Without it, you are essentially driving uninsured the second you look for work on a digital platform. The myth that the app's insurance is all you need is a high-stakes gamble that fails the moment the wheels start turning in Period 1. Step by step, the industry has tightened these definitions. In 2026, insurance companies are using digital forensics and data sharing with tech platforms to see exactly when an app was active. If you try to hide the fact that you were ride-sharing during an accident, the insurance company will likely find the digital breadcrumbs. This can lead not only to a denied claim but to a permanent blacklisting from major carriers, as it is classified as material misrepresentation. This brings us to the broader myth of business use versus personal use. Many Americans believe that as long as they aren't driving for a famous rideshare brand, they are fine. Consider a small business owner named Sarah in Columbus, Ohio. Sarah uses her personal SUV to deliver cakes for her boutique bakery. She doesn't have a commercial policy because she is the only driver, and it is her personal car. In 2026, if Sarah has an accident while the car is filled with cake boxes, and she is on her way to a delivery, her insurer can deny the claim. To the insurance company, the frequency and nature of business driving represent a higher statistical risk of an accident. They haven't collected the premium necessary to cover that risk. Whether you are delivering pizzas, real estate signs, or medical supplies, if the primary purpose of the trip is profit, your standard personal policy is likely insufficient. Now, let us move into the hidden world of insurance scores and your digital footprint. Most Americans are aware that their credit score affects their rates, but in 2026, a new variable has entered the equation: the insurance score derived from consumer behavior. Imagine a consumer named Jason in Austin, Texas. Jason is a safe driver, but he has a habit of frequently shopping at late-night convenience stores or frequently visiting high-risk entertainment districts, as evidenced by his credit card transactions and GPS data from apps he has granted permissions to. Historical trends indicate that insurance companies are now purchasing anonymized behavioral data to build more complex risk profiles. They aren't just looking at how you drive, they are looking at where you go and your lifestyle stability. If the data shows a pattern that correlates with higher claim frequency, such as late-night lifestyle habits or frequent changes in residence, your insurance score may drop. This happens in the background without you ever receiving a notification. You simply see a higher premium than your neighbor, even if you both drive the same car and have the same driving record. This level of data-driven pricing is the new frontier of the 2026 insurance market, and the myth that your driving record is the only thing that matters is officially dead. Let's look at a case study regarding the documents you keep in your vehicle. There is a common belief that you should keep your vehicle's title in the glove box, so you have it if you are pulled over. This is a dangerous myth that facilitates vehicle theft. In 2026, if a thief steals your car and has the physical title, they can much more easily forge a bill of sale or move the vehicle across state lines before you have even realized it is gone. You should only keep your current registration and a digital or physical copy of your insurance card in the vehicle. Furthermore, the myth of the physical insurance card is evolving. While most U.S. states now accept digital proof of insurance on a smartphone, there is a hidden risk. If you hand your unlocked phone to a law enforcement officer to show your insurance, you may be inadvertently granting them access to see notifications, messages, or other private data that appears on the screen. In 2026, savvy drivers are using the lock screen features of their phones to display insurance information without unlocking the device, or they are keeping a high-quality printed backup to avoid the privacy risk altogether. We must also address the myth of the roadside assistance trap. Many people believe that using the roadside assistance feature on their insurance policy is a free perk. However, in the eyes of the insurance company, every time you call for a tow or a jumpstart, it is logged as a claim. Even if it is a $0 payout from your perspective, it appears on your CLUE report. Case studies show that drivers with 3 or 4 roadside assistance calls in a 3-year period are often flagged as high maintenance or high risk. When it comes time for your policy renewal in 2026, you might find your rates increasing or your policy being non-renewed entirely, all because you used a service you thought was a simple convenience. Many experts now suggest having a third-party roadside assistance membership that is completely separate from your insurance company to keep your claims record pristine. As we approach the final sections of this masterclass, we are going to look at the massive shift toward automated enforcement. In 2026, many cities are using AI-powered cameras that can detect not just speeding, but whether your vehicle has an active insurance policy in real time. We are going to explore the consequences of a lapse in coverage, which are far more severe than a simple fine. We will also reveal the one thing you must do if you are ever in an accident with a self-driving or highly autonomous vehicle. The legal protocols for these accidents are entirely different from a standard collision, and if you follow the old rules, you will likely lose your claim before it even begins. In the next part, we are going into the mechanics of the 2026 legal landscape and how to protect yourself when the driver of the other car isn't a human at all. The shift toward automated legal landscapes in 2026 has created a new category of insurance myths that are catching even the most seasoned drivers off guard. The first of these is the belief that if you are hit by a self-driving car, the manufacturer is automatically liable. Imagine a driver named Amanda in San Francisco. Amanda is sitting at a stoplight when a late-model vehicle operating in a highly autonomous mode rear-ends her. Amanda assumes that because a computer was driving, she can simply file a claim against the multi-billion-dollar tech company that built the car and receive a massive settlement. In the real-world legal landscape of 2026, this is a dangerous misunderstanding of product liability versus auto insurance. Most autonomous vehicles on the road today still require a human in the driver's seat to act as a fallback. This means that for the purposes of a standard insurance claim, the liability often remains with the individual owner of the vehicle and their personal insurance policy. Unless Amanda can prove a specific hardware or software failure through an incredibly expensive and lengthy forensic data analysis, the tech company is likely not going to be the primary respondent. Case studies from recent autonomous accidents show that the burden of proof has shifted. When Amanda's insurance company tries to subrogate against the manufacturer will produce gigabytes of telematics data, showing that the human occupant had 3 seconds to intervene and failed to do so. This effectively pushes the liability back onto the individual's insurance policy. If that individual carries low limits, Amanda is back in the same position she would be in with any other driver. The myth of the deep-pocketed manufacturer settlement is, for now, a legal mirage. To protect yourself, the step-by-step process remains the same. Treat the accident as if a human was driving. Take photos of the sensors, note the software version if displayed on the dashboard, and immediately secure your own dashcam footage. In 2026, your dashcam is your most important witness when fighting an algorithm. This brings us to the second major development of 2026. The myth that a short lapse in insurance coverage is no big deal, as long as you don't get into an accident. Imagine a driver named Gregory in Chicago. Gregory misses a payment because his credit card expired, and his policy cancels. He figures he will just pay it on Friday when he gets his paycheck. He thinks that since he is a safe driver, 3 days without insurance is a low-risk situation. However, in 2026, many U.S. cities have fully integrated their automated license plate recognition systems with the state's Department of Motor Vehicles database. As Gregory drives to work, a police cruiser or a stationary camera scans his plate. Within milliseconds, the system flags his vehicle as having no active insurance. Gregory isn't pulled over immediately. Instead, the system automatically triggers a suspension of his vehicle registration and sends a notification to his state's DMV. The fallout is catastrophic. When Gregory goes to reinstate his insurance on Friday, he finds that he is now classified as a high-risk driver due to the lapse. His premium doesn't just go back to normal, it doubles. Furthermore, because his registration was suspended, he has to pay significant reinstatement fees to the state. Historical trends in 2026 show that insurance companies view a lapse of even 24 hours as a major red flag for financial instability. They use this data to move you into a non-standard rating tier, which can stay on your record for 3 to 5 years. The myth that you can just catch up later ignores the fact that the digital eyes of the state are watching your insurance status in real time. A third myth is the belief that your insurance covers you for any modifications you make to your car. Let's look at a case study involving a driver named Derek in Las Vegas. Derek spends $6,000 on a custom wrap, aftermarket wheels, and a high-end sound system for his truck. He assumes that because he has comprehensive and collision coverage, these upgrades are protected. When his truck is stolen and recovered stripped of all the custom gear, the insurance company offers him a settlement based on the factory specifications of the vehicle. Derek is shocked to learn that standard policies typically limit coverage for custom parts and equipment to a very small amount, often only $1,000, unless he specifically declared the modifications and paid an additional premium for a custom equipment endorsement. In 2026, with the rise of car culture and personalized electric vehicles, this gap is wider than ever. If you don't have the receipts and the specific rider on your policy, the insurance company treats your $6,000 investment as if it doesn't exist. Step by step, you must document every modification and send it to your agent to ensure your limits actually reflect the true value of the vehicle you are driving. Now, let us tackle the myth of the medical exam. Many people believe that if they are injured in an accident, the insurance company's request for an independent medical examination is a neutral evaluation of their health. Imagine Amanda again, who is dealing with persistent back pain after her encounter with the autonomous car. The insurance company schedules her for an IME with one of their doctors. Historical trends in insurance litigation reveal that these exams are rarely independent. The doctors are hired and paid by the insurance company. Their goal is often to find a reason to argue that the injury is not as severe as claimed, or that it was a pre-existing condition. In 2026, these doctors are equipped with AI-assisted diagnostic tools that can compare your scans to millions of others to find any sign of degenerative changes that would have existed before the accident. If they find a single speck of arthritis in your spine, they will use it to argue that the accident didn't cause your pain, aging did. Understanding that the IME is a defensive tool for the insurer is vital. You should never go to one of these exams without knowing that every word you say and every movement you make is being evaluated to potentially minimize your payout. Finally, we have the myth of the disappearing accident. People often think that if they don't report a minor fender bender and just pay for it out of pocket, it will never haunt them. Imagine Gregory again. He taps a car in a parking lot, gives the person $500, and they both go on their way. No police report, no insurance claim. But what Gregory doesn't know is that the other driver, 2 weeks later, decides their neck hurts. They go to a doctor and mention they were in a minor accident. That medical record can find its way into a database. Or perhaps the other driver takes their car to a body shop that reports the VIN and the damage to a history provider like Carfax. Suddenly, The insurance company sees that Gregory's car was involved in an unreported incident. When Gregory tries to renew his policy, he is flagged for a potential rate increase because he failed to disclose an accident, which is a violation of the policy's reporting requirements. In 2026, the interconnectedness of data means that there is no such thing as a truly off-the-books accident. As we reach the final part of this masterclass, we are going to tie everything together to show you how to build a bulletproof insurance strategy. We will reveal the exact checklist you need to run through every 6 months to ensure you are paying the lowest possible rate for the highest possible protection. We are also going to look at the future of the industry, including the emergence of peer-to-peer insurance, and how the total phasing out of human drivers in certain zones will change your policy forever. If you want to know the one thing that will save you more money than any discount or trick, you cannot afford to miss the conclusion. We are finishing this deep dive with the master key to the insurance kingdom. The master key to the insurance kingdom is not a secret discount code or a hidden website. It is the strategic mastery of your own risk profile and the proactive management of your policy as a dynamic financial asset. We have spent the last 9 segments dismantling the myths that have kept most Americans in a state of expensive confusion. But in this final part of our masterclass, we are putting the power back into your hands. Imagine a driver named Marcus in Atlanta, who we have followed throughout this journey. It is now the end of 2026, and Marcus has decided to move from being a passive consumer to a proactive policyholder. He realizes that the one thing that will save him more than any single discount is the consistent, semi-annual audit of his coverage limits and the data that insurers are using to rate him. The first step in this master key strategy is the deep audit of your declarations page. Most people see this page and their eyes glaze over, but this is the blueprint of your financial protection. Historical trends in 2026 show that the most successful policyholders are those who treat this document like a living contract. You need to look at every single line item and ask, does this still reflect my life today? For example, Marcus realized that his commute had changed. He was no longer driving 40 miles a day. He was working from home 3 days a week. By updating his annual mileage with his insurer, he saw a potential outcome of a 12% reduction in his premium. This is not a discount he was given. It was a correction based on his actual risk. Step by step, you must also evaluate your liability limits against the current economy. In 2026, with the average price of a new car hovering around $50,000 and medical costs rising, the old standards of 100/300/50 are no longer the gold standard. They are the bare minimum for middle-class protection. If you have assets like a home or a retirement account, you are a target for litigation. Case studies from 2026 legal filings show that trial attorneys are increasingly looking for drivers with high-value assets but low insurance limits, as this creates a path for personal judgments. Raising your liability limits to $250/500/100 often costs only a few dollars more per month because you are moving into a more responsible rating tier. This is the irony of insurance. Sometimes carrying more coverage makes you a more attractive risk to the company, leading to a lower overall rate than someone carrying minimum limits. Next, we must look at the future of the industry, the emergence of peer-to-peer insurance and fractional coverage. In 2026, we are seeing the rise of decentralized insurance pools where groups of low-risk drivers pool their premiums to cover each other, with the surplus being returned to the members at the end of the year. While this is still a niche market in the US, it represents a massive shift away from the traditional corporate model. Furthermore, fractional coverage is becoming a reality for the urban driver. Imagine Sarah in Miami, who doesn't own a car but uses various mobility services. In 2026, she can purchase a policy that follows her, not a specific vehicle. This policy covers her whether she is behind the wheel of a rental, a friend's car, or even an autonomous shuttle. This eliminates the confusion of who is liable during a transition of control. But as we look toward the horizon, we must address the ultimate myth, that human drivers will always be the baseline for insurance. In late 2026, we are seeing the first zones in major US cities where human-driven vehicles are being charged a premium just for entering, due to the higher accident rate compared to fully autonomous fleets. The insurance industry is already preparing for a world where the driver is no longer a human, but a software suite. When this happens, the entire concept of personal auto insurance will transform into product liability insurance. For you, the driver, this means your policy may one day be included in the subscription price of your vehicle's software. Until then, you must navigate the transition period where you are being judged against the perfect, tireless performance of an algorithm. This brings us to the final piece of the master key, the data reclaim. In 2026, you have more rights than ever to see the data that companies are using to judge you. Under various state privacy laws, you can request your consumer file from companies like LexisNexis and Verisk. Imagine Anthony in Philadelphia, who found an error on his CLUE report that listed an accident he was never involved in. By filing a formal dispute and having that error removed, his insurance premium dropped by 20% overnight. This is the level of detail required to win in the modern insurance market. You cannot assume the data is correct. You must verify it. Let us look at a final case study involving Jennifer in Florida. Jennifer was a perfect driver with a high insurance score, but her rates were still climbing. She decided to implement a strategy of shopping her policy every 12 months, regardless of how happy she was with her current carrier. In 2026, she used an independent agent who had access to 40 different carriers, including smaller, regional insurers that don't spend billions on television advertising. By moving to a regional carrier that specialized in her specific demographic, she was able to maintain her high limits while reducing her annual spend by over $800. This highlights the myth that the biggest companies always offer the best value. In the insurance world, the biggest companies often have the highest overhead, and you are the one paying for those Super Bowl commercials. Step by step, the path to insurance mastery looks like this. First, maximize your deductible to what you can afford out of pocket to lower your base rate. Second, increase your liability limits to protect your net worth and move into a preferred rating tier. Third, audit your data reports for errors at least once every 2 years. Fourth, shop your rate annually with an independent agent who can look beyond the big box brands. And finally, never, ever accept the first offer in a claim scenario without doing your own due diligence on the valuation of your vehicle and the extent of your medical needs. As we conclude this deep dive masterclass, you now possess a level of understanding that puts you ahead of 99% of the driving public. You know that the color of your car doesn't matter, but your credit score does. You know that full coverage is a myth, but gap insurance is a necessity. You know that the insurance company is a business, not a guardian, and that your policy is a legal tool that requires your active management. The American road is changing, and the ways we protect ourselves are evolving with it. While this concludes our 10-part masterclass on car insurance, the world of financial protection is much larger. If you think the car insurance industry is complex, wait until you see the hidden mechanics behind the home insurance crisis of 2026, where entire zip codes are being blacklisted by insurers due to climate modeling. In our next series, we are going to dive into the world of property protection and the one document that could prevent your home from being uninsurable in the next 5 years. You have the master key for your car. Now it is time to secure your home. We will see you in the next deep dive.